So one thing that's going to test this demand is the redevelopment of the Meijer Centre. Of course, that's going to be the big issue for 2011 here in the CBD. What impact do you think that will have on existing retailers and retailers coming into the market here in Melbourne?
Look, it's an interesting development, the Meijer redevelopment, which is known as the Emporium building. It's located in the centre of the CBD and basically a 4-level shopping centre made up of specialty shops and a few flagship opportunities. Now, this is going to have a significant impact on the retail core by basically acting as a staple between the northern retail component of the CBD, which is Melbourne Central and QV, to the prime and super prime retail location of the CBD, which is Elizabeth Street, Swanston Street, Flinders Street, Flinders Lane, Little Collins, and Bourke Street Mall. But the impact that that's going to have on the secondary retail market is going to be quite significant, because boutique retailers located in the eastern part of the CBD in Little Collins Street and Bourke Street are going to be seduced by these new prime retail opportunities and relocate, and that will in turn leave quite a bit of vacancy. However, we're quite confident that that level of vacancy will be absorbed by boutique retailers looking to expand into the Melbourne CBD but haven't had the opportunity. And in 2010, we saw a number of these type of retailers expand into the secondary markets, like a lot of Australian brands like Arabella Ramsey, Life with Bird, Zoology and Plain Clothing are just a few examples of that.
So, Mark, let's bring you into the conversation on the investment market. Retail is notoriously tightly held. Where do you think the opportunities will come from to buy retail property in 2011?
Yeah, it's a very good question, and obviously I come to the breakfast each year hoping that the answer might be a little bit different, and I'm sure a lot of buyers in the audience do as well. But unfortunately, we don't see any landmark event acting as a trigger for more stock to hit the market. A lot of the early calls this year seem to be following a certain pattern. So we've concluded that there are 3 areas of interest that we're monitoring, and 3 areas where we think more stock may well come onto the market. The first is the natural decrease in the bank's attitude towards LVRs of shopping centres. I was speaking with a banker earlier just outside, and I asked the question where the LVRs may have got to in the height of the market of 06 and 07, and it was sort of 75 to 80% as a percentage. And I said, where would they sort of sit now? And he said, look, it could probably be as low as 55 or 60. Now, if you're talking about a freestanding supermarket at $8 million, for example, it's probably not going to be a major issue. But if you're talking about a large centre of 50 or 60 or 70 million, in order for a vendor or an owner to come up with that equity required to refinance at the lower LVR, we think that could be a trigger for some stock to come onto the market. The second point, and I think this is probably a little bit more pertinent because it's actually happening in the marketplace at the moment. And for all of you that read the newspapers like we do every weekend, you'll see an increased number of retail development sites starting to appear in the newspaper. The really interesting thing about these sites is we're defining them as package sites. So we think developers have gone out, bought greenfield sites with no permits and no pre-commitments, done a lot of the hard work to get rezonings, pre-commitments and planning permits, and due to funding, again, are in a position where they might not be able to fund them. So we think that's going to be a trigger for sure, and that's happening in the marketplace at the moment, so that's something to look out for. The third and final point that I'd like to make in that regard, again, is probably more factual, and we think it's something that's probably going to last for more than just the 2011 outlook. It'll probably last into 2012, and that is the major national Australian retailers offloading properties that they've developed through the GFC, basically because developers weren't in a position, or a lot of developers weren't in a position to deliver, and groups like Woolworths, obviously, with the portfolio they put on the market last year. And for everybody in the audience, I'm sure a lot of you would have read about the Bunnings Trust transaction last week of 13 Bunnings properties which they bought from a subsidiary effectively of Wesfarmers. So we think that'll continue on for a good 12 to 18 months, and obviously they need to package the assets up in terms of their leasing profile so that they're attractive for investors. Okay, so what about for existing owners? How are they likely to add value to real estate in the year ahead? I mean, Max, you're talking about a long list of retailers who may be in the market. Do you think the key is with working with those retailers into existing properties?
Yeah, well, within the Melbourne CBD, certainly there's an opportunity for landlords to upgrade their existing tenants. Traditionally, the smaller retailers that are known as mum and dad retailers are currently being replaced by national retailers in the Melbourne CBD. And a perfect example of this was 193 Elizabeth Street, where McGill's had their big news agency there for a significant amount of time, and a developer bought the site, effectively chopped it up into 3 shops and leased it to national retailers such as Subway, Michelle's Patisserie and Wildcards and Gifts.
So you think that could work for the broader suburban malls as well, Mark, as some sort of more introduction of national or even international retailers?
I think that's definitely an opportunity. I don't think the outlook's probably changed in terms of giving this advice that we gave last year, and that is we think it's going to be another year of rolling the sleeves up, owners looking at their assets, looking at their tenancy mixes and tenancy sizes in particular, and potentially looking at, like Max said, somebody's bought a whole building, turned it into 3 shops and driven rents, and we think there's opportunities within the shopping centre market to obviously drive that as well. So we think rentals could be driven by that. A slide that we've just brought up here, and I know it's always a bit of a favourite of people that attend. Again, it's not majorly different, but the real opportunity for owners and developers in the audience is the national retailers are very aggressive at the moment. They're all looking to increase market share either through existing brands or new brands, and a great example has been Coles with First Choice Liquor, something they're trying to obviously compete quite fiercely with Dan Murphy's. We see these national requirements as a real opportunity within existing centres to replace bigger tenants that may want to go smaller and put one of those brands in, or even for, I suppose, more of the conservative developer, using some of these pre-commitments you might get in place to trigger a stage 2 or a stage 3 of an existing shopping centre that has development potential.
Okay, so in a way of summary, any final tips for clients for the year ahead, Max?
I think most people underestimate the market rent in the Melbourne CBD, so they should always be looking at recent examples, because since I've been in the market for the last 5 years, there has always been an opportunity to repeg the rent higher than what the passing rent is.
Good. I suppose the opportunity is just, retail's detail. The only constant in retail property is change, and we think it's going to be a year of change in terms of tenant requirements for sizes. So really, open the book back up, have a really good look at the asset, and if we're not going to be banking on yield compression, which I agree with, just roll the sleeves up and look at where some significant value can be added, and look for value that way.
Okay, that's great. I think there's some terrific ideas there. So please join me in thanking Mark and Max this morning.
Thanks, Kev. Thanks,
Charles.
Well done.
Okay, we're going to move now to the final section of the presentation, which is to talk about Melbourne hotels. To do that, I'm going to invite Scott Kello from our Melbourne office up to give us an update on the hotel sector. Welcome, Scott. Okay.
Thanks, Kevin.
Right, now, Scott, Melbourne's been one of the few markets, really the only market around the country that's actually delivered any new rooms into the market over the last 18 months or so. How's it impacted the market? How's it faring now?
Well, Kevin, we sat here at the breakfast last year and were concerned somewhat by the opening of the Hilton South Wharf, the potential opening of the Travelodge in Docklands, and we saw those new hotel offerings as being a real risk to 2010. In addition to that, obviously Crown Metropole was to be the largest hotel here in Melbourne and, of course, Australia. What we've seen come from the last 12 months is that we've got a very resilient market. The only real addition to the market that we saw was, in fact, the Docklands property and the addition of the Art Series hotels in South Yarra and Paran. I think it's fair to say that the markets remain strong. Room rates have suffered to a small degree, but room night demand has grown. And off the back of that, I think the market's looking very strong moving forward.
Okay, so the total pie, I think, has actually grown.
That's correct.